Hey, this is Carl from Ushanka. This is my fourth video on precious metals investing. It's the first and only video on strategy number two. Remember, this is not advice, it's just my research, and my focus is investing, not stacking. My motivation behind this video and the previous videos is that I think some stackers have been duped by personalities on YouTube that are either portraying themselves as experts or are considered experts by the community. Yes, precious metals are good for wealth preservation, but I want to see what we can do as far as enjoy the benefits of precious metals uh, with getting wealth creation rather than wealth preservation. These experts out there, I have come to start to suspect a bit. I've done about 10 or 15 hours of work on this Excel spreadsheet that made up strategy number one and now this strategy number two. It's not a lot of work, and it's actually very simple, and yet it appears to be more research and more math than any of the so-called experts have done. So I wanted to point that out. Next time somebody makes a convincing argument, did they actually do the math, and are they qualified to be making those statements? I'm just disappointed in the overall level of knowledge out there that's portrayed as expert. But I'm on board with the reason behind metals. I like the idea that they're harder to confiscate. They're not zeros and ones on some server. And, if we are going to have currency issues, it's great protection against that. So let's get started. Here's the slide. I showed this in the last video. This is the 10 years of data I've been using, January 2004 to December of 2013. And we learned that the average silver to gold ratio is 58 to 1. And what I wanted to do is find the special ratio triggers here over the last 10 years that would have allowed me to create wealth using precious metals rather than just preserve wealth. And that's what I'm presenting to you today. What I did is just subtracted 10 to get the silver for gold ratio trigger that where we will trade silver for gold. And when the ratio hits 68 to 1 or 10 over the average, that's when we'll trade that gold in for silver. And the idea is accumulate metals. You're going to only have a few trades over the period of 10 years. But the idea is because you've traded on the ratio and on these specific triggers, you will create wealth. You will beat what the stacker does when he preserves wealth. This strategy number two is for the serious metals investor. It's in place of a 401k, IRA, or bank savings account, or it might be in tandem. And my goal here is to accumulate gold over time, to lean towards gold, and also to limit the amount of silver one accumulates. Again, we're talking bigger numbers. I'm going to present three trade scenarios. Each has its own ROI. One is for physical premium, like the American Eagle coins. One is for the discount. Those might be rounds or bars. And then the ETFs. Okay, so strategy number two, the investor is going to invest a total of $64,500 over a period of 10 years. He's going to put $5,000 in on month one and then $500 each month thereafter. He's going to accumulate cash until a ratio trigger occurs, and that's when he will buy metals and do a trade if he has metals on hand. I want to maximize the silver to 1,000 ounces. The idea being logistics. It'd be really hard to start trading in silver when you're talking about more than 1,000 ounces at a time. The idea is also that this is how we favor gold, that once we hit that limit of silver and we buy into silver because the ratio is telling us to buy into silver, we'll buy that 1,000 ounces, but we'll also have metals on hand that we didn't use for the trade, and that, of course, would be gold. And so the idea is as you go through this over the period of several years, the gold will always stack up, and the most you'll ever have on hand of silver is 1,000 ounces. So a little bit different than strategy number one, where we only had three trades or three transactions over the period of 10 years. We had a wider, more aggressive ratio triggers in strategy number one. Here in strategy number two, we're going to have more transactions because we have a more narrow ratio trigger set. But I also wanted to point out that we have transactions and we have trades. And we had 15 transactions in strategy number two. I want to point out the span of January 2011 to September of 2011, where the ratio was always in play between 35 and 1 and 48 to 1. And therefore, in January, January 2011, when the ratio first hit 48 to 1, we traded silver for gold. But then February came around and the ratio was still optimal for gold, so we bought gold with that $500. Okay, so the idea is just the way I would behave as an investor if I had done the ratio trigger as planned, and then the next month gold was even more optimal, or the ratio was more optimal. I would take that $500 and put it in. I wouldn't start accumulating cash when gold was a good buy at the time. So what you'll see is 15 transactions, but there were only 3 trades where there were only times where the ratio went from 48 to 1 then up to 68 to 1 and triggered a trade. So that's an explanation of the data you're going to see here. What's calculated is the trade cost and of course the spot price of the metals. What I did not include is shipping if you're trading metals in through the mail. And I didn't include any interest earned if you're accumulating cash in a bank account. All right, so the trade fees are the same. Just go ahead and pause this if you want to look at it. I'm not going to speak to the specific numbers. It's the same premium same trade fees I used in the previous video. And go ahead and pause this too if you want. I only wanted to draw your attention to a couple things. You can see that some are called buy and some are called trade. And trade means that a ratio trigger clicked while we had metals on hand, and then we went ahead and bought. So you're looking at the October 2008 trade in premium. You'll see that we had gold and we traded it in for 1,000 ounces of silver, and then we still had 29.6 ounces of gold on hand because we hit that trade limit. You can see the trade limit was hit earlier in the discount and ETF scenarios. So that might help explain what's going on. And you can see the ratios where these triggers hit. Again, go ahead and pause this if you want to look at the exact data. Okay, so the results from this, again, remember 64,500 total invested. And our ROI for the premium metals, as we learned in the previous videos, it was only 49%. It's actually lower than if you were strictly stacking metals. Discount pays out better, so you go for those rounds and the coins that aren't in demand, you do better there. But of course, like we've proven before, the ETF is the place to go if you want to really do wealth creation on metals. And you can see that 74% ROI, that exceeds wealth preservation. That is wealth creation, even although a little small for 10 years. All right, so I covered pros and cons last video, but I wanted to kind of hit on it a little bit more. The things I want to point out, premium metals are easily transferable. It's a known quantity. It's minted by a government. So the American Eagle, for example, is known and is easily transferable. So I wanted to bring that out in this. And then with the ETFs, you're liquid. Even though you don't have cash on hand, with a click of a button, assuming everything's working, you can get your money out of your investment quite quickly. And of course, that was the best return on investment. As far as cons go, I wanted to point out that when you're stacking, you don't have cash on hand because in theory you're putting all your cash on hand into metals each month. So that's kind of a downside. Obviously, stackers probably have some cash that they've set aside, but they're stacking for a reason. Do they have cash on hand for the reason? Remember, premiums are the lowest return on investment. It's also the kind of metals I prefer, as you saw in my Custjar videos of the last few weeks. So I'm hurting myself by doing these nice coins, but that's a trade-off I'm doing. My collection is not so much about wealth creation as a real collection would be. And then on the ETFs, as far as cons, we have the introduction of the government risk, trying to pull out savings, like Cyprus, or the Wall Street risk of, the Wall Street just not being available at the time you want to sell or do a trade. All right, and then also the discount, I just want to point out the less transferable. I think if in the worst case scenario, the it's hit the fan sort of thing, um, those that are going to take your coins in exchange for goods like food are going to be looking for the kinds of coins that they can then pass on to their suppliers. And I think that's where premium gains, and I think discount does not. If you're looking at a nice 1 ounce silver round that has no mintage, no government behind it, how do you know it's 1 ounce? How will my supplier know it's really 1 ounce? That sort of thing. So that's the downside on discount. As far as future videos, I don't have any plans to do any, but if there's major metal news, I will do a video. I will do a video if I end up doing a ratio trade. I have set 48-1 for my cuss jar collection. And I will probably do a video on January of 2017. That's when I plan on selling my current stash, and combining it with the cash that's still in the cuss jar and treating myself to something special. So otherwise, don't plan on seeing any more videos from Ushanka. It's been an honor to provide this research. I hope you've learned something. I hope I've helped the community, and I hopefully have set the bar a little higher for those people out there to call themselves experts. You guys have a great day, and remember, CommieObama.com is where you can buy the nicest, furriest, sexiest hat out there. You guys take care. Bye.